Hi, thanks so much for joining in. You're watching BQ Prime. My name is Alex Matthew, and this is an earnings conversation. We're joined on the phone line by the management of Escorts Kubota. Bharat Madan, whole-time director and chief financial officer of the company, is joining in. Bharat, thanks so much for taking the time. We're talking about the second quarter, and the PAT number certainly looks really good, up as much as 2.3%, and the revenue number is higher by about 9%. I think that's largely driven by a substantial expansion in the margin. But before we get into the margin picture, I do want to talk about the top line and the fact that your businesses, aside from tractors, seem to be firing on all cylinders. What can you tell me about that spliced revenue figure and the fact that the mix is changing quite substantially?
Yeah, you're right. I think if you look at the second quarter, first, because one of the reasons was this was a soft quarter for the tractor business. So normally tractor business used to be almost 75% plus of our top line for the company as a whole. But this time it's a soft quarter. And as you mentioned, the other sectors, the construction equipment as well as the railway business are doing extremely well, growing almost at 50% plus pace. So that's why I look at the mix of the overall businesses. Now every business has roughly in this quarter shifted down to almost 68%, and 32% revenue came from the other two businesses which were infrastructure mix. So that is a swing which is positive. So I think that's also helped us in the margin expansion. But obviously, as we go forward, we expect the tractor business will also pick up. So there's a temporary shift in the festive season which has happened this time from Q2 to Q3. So probably you'll see a better traction coming in the third quarter.
Okay. I do want to ask about the tractor outlook though, because what we're hearing from the industry and your peers is that there is expected to be some softness there in demand. Is that what you're hearing as well?
Yes, if you look at the first 6 months, obviously the industry has shown almost 4% decline, in the domestic market. And October also was a slightly slower month. So in November, we expect the growth will come in. So I think first 6 months has shown the degrowth, but Q3 we expect there will be a positive momentum. Even though it may not be very high, it may be only a small minor 2-3% sort of growth for last year. And similar trend probably will be there in Q4 too. So I think from full year perspective, we expect it to be maybe plus minus 2-3% sort of growth over the last year number. But I think having said that, one thing to notice, last year was a record year for the tractor industry, so it's probably getting increased. So then if we are able to maintain that number, I think this year, I think it is a good scenario for the tractor industry given the patchy monsoon we had this time. So it's led to some pressure on the market demand.
Bharat, that the other businesses are cushioning the impact of this softness in demand for the tractor business, construction equipment and railway equipment division. And as you pointed out, it's a substantial increase in the contribution. Is that the new normal though? Do we see that continue? And is this the primary reason for the margins expanding, or are there other factors at play? For example, a reduction in pressure on the cost side?
So I think it's a combination of both. So as you've seen, the push from the government on infrastructure spending is huge. So there's a large capex outlay which government had boosted this year. So that is now getting visible on the ground and the project execution is happening. So which is where you're seeing a very strong demand coming up for the construction equipment business and for the railway segment too. However, this will continue, so obviously tractor will pick up. So like I said, Q2 was a soft quarter for us, but Q3 we expect the mix will be slightly in favor of the tractor business. Even though both construction and railway will also continue to grow at this pace. So yes, to some extent swing has happened, and fully that is for the good, where the margin expansion is also coming up because of that reason. So overall, we can still expect tractor will still remain in dominant, I think, part of the overall revenue. It may not be in the same range that it used to be. Maybe 70-odd% sort of share will come from the business going forward.
What I was driving at, Bharat, is the profitability. Seemingly, these construction equipment as well as railway, and particularly railway, I would think, seem to be more profitable. Correct me if I'm wrong. Realization seem to be better there. And so from that perspective, I'm wondering if it's a more conscious effort to make the mix a little bit more favorable in terms of those two businesses.
Yeah, I think if you look at the 2-3 factors which have played in terms of margin expansion. One obviously is the softening in the commodity prices, which has helped across all three business verticals. So it's almost 1.5-2% improvement in margin has come because of that. And then we had taken certain price increases across both the segments, construction equipment as well as in tractor business, to offset some of the unabsorbed inflation which we are carrying forward, from the previous increases. So that has also helped the margin by roughly 1.5%. In construction, we are seeing very good product mix, which is very favorable. So we are selling the high-end equipment cranes, which are better margin, better contribution products. So that is another thing which has helped the margins. If you look at construction business, we have a record margin of double-digit actually, which will never happen in our history. And at this level, and the volumes are likely to pick up further, in the coming 6 months. So that should only give us positive, impact on the margin front too, going forward. So overall, I think will be a good year, from margin perspective for the company level.
Can you give us a sense of the order book in those two businesses, particularly railway?
So railway, we were at 870 crores approximately order book at the end of September. But the order book is not that much relevant because our pace of execution has increased quite a bit now. So you look at our last 6 months number, it's almost 530 crores plus top line. So we're executing faster, whatever orders we're getting. So which means as long as the order inflow continues, which is happening today, so you continue to see the good growth, momentum maintained in the railway industry.
Okay. Could you give us a sense? I'm so sorry, but your voice is not coming through very clearly to me. But and I'm not sure if you talked about how quickly this has grown. But can you talk about where it stood last year, the order book?
Yeah, so it has been the similar range. So it has been in the range of 800 to 1,000 odd crores. But earlier our execution pace was not that good because we had issues in the capacity side from the vendor side, which has been now, taken care of. So that's why you see the number of orders we executing is much faster now. As a result, the quarterly revenues have gone up significantly. So there's almost 50% increase which has happened in the last 6 months in the railway revenue. So which means the order book is still there and the fresh order flow is continuing. But the pace of execution is also getting better. So which means we'll continue to see good revenue growth in the coming quarters.
Leave us with a thought of how you think the first half has been and therefore how you think the rest of the year will pan out. Do you think that these two businesses, the fact that they've done well, have pushed you ahead of expectations that you had, or you're more or less in line with those expectations, and therefore leave us with an idea as to how you see the whole year panning out in terms of top line and bottom line?
So I think on construction equipment side, we expect the second half is normally better. First half normally because the monsoons, pace of activity and execution of electric flow. But the second half sees the maximum demand. So we expect in construction will do a better performance in the balance 6 months. On the railway front, it will be more or less similar to what we've done in first half. So it's not going to be a major change from the first half numbers. So similar things slowly will get repeated in the second half too. On agri business, we expect second half will be better this time compared with the first half because the change of season, festive season which has happened to Q3. So we expect the numbers will look better actually in the second half. So overall, I think the next 6 months look more promising than the first 6 months we've seen in this country.
Fantastic. Bharat, thanks so much for taking the time. Look forward to speaking to you in the next quarter as well.
Thanks. My pleasure. Thank you.
All right, viewers, there you have it. The management of Escorts Kubota speaking about the quarter gone by and also the outlook for the rest of the financial year. Do stay tuned. Lots more coming up on BQ Prime.
I wish all our consumers, passengers, our employees, our partners, and really all viewers a very happy, most importantly, a very safe Diwali.